Struggling to understand DR models and how to anticipate upcoming DR sessions? In this video, I'll break down 7 standout trades from last week, showcasing early model identification, broken DR models, and powerful DR characteristics that led to huge intraday trading opportunities. Stick around. Each trade is packed with actionable insights you won't want to miss. Number 7. Crude oil futures, Thursday's overnight DR session trade in a DR downside model. Let's break down Thursday's overnight DR session on crude oil, where the DR downside model provided a textbook setup for traders who were well prepared. The relationship between the aftermarket and overnight DR session already hinted at a possible DR downside model. The overnight DR session respected the aftermarket DR levels and closed as a red DR box. This early structure suggested a higher probability for shorts throughout the session. To solidify this bias, we ideally want a short confirmation, as it would strengthen the likelihood of a DR downside model continuation. On the other hand, a long confirmation would slightly weaken this probability, requiring adjustments in expectations. Price initially failed to close below the defining range, but eventually found its way lower with the 5:05 a.m. candle. This was a positive sign. Why? Because statistically, once price closes below the defining range, there's only about a 20% chance of a DR false session, where price would close above the defining range again. With this established, it is time to prepare. The first step is to highlight previous DR session levels that aligned with the current defining range. These levels would be crucial for understanding potential barriers or supports as the session progressed. Next, important volume and gap imbalances should be marked, starting with the 2 intraday gap imbalances from the aftermarket DR session. These imbalances had already acted as barriers for price and could continue to do so. Additionally, several previous volume imbalances are noted, especially one that perfectly aligns with the plus 2.5 standard deviation level, which would act as a magnetic target for price. As the session unfolded, price retraced back into the defining range and stopped at the IDR mid. Here, it rejected the level twice, failing to close above it. This was an ideal spot for considering the first position of the session. While the standard recommendation is to place a stop loss at the minus 0.7 retracement level inside the range to allow for a potential second entry if stopped out, this session called for a slightly wider stop. Including previous DR session levels in the stop loss placement is wise, as they could act as minor resistance zones without impacting the risk-to-reward ratio. Targeting the next standard deviation level of 1 still provided an excellent risk-to-reward ratio in this case. This setup was clean and precise, with multiple confluences aligning in favor of a DR downside continuation. It's a beautiful example of how preparation, patience, and the DR basics come together for high-probability trades. Number 6. S&P 500E Mini Futures. Monday's regular DR session trade in a broken DR downside model turning into a range expansion. Monday's price action on the S&P 500E Mini Futures showcased another great example of the DR intraday cycle in action, with clear characteristics across all 3 DR sessions. A DR downside model is intact, with each DR session respecting the highs of the previous session. In a perfect continuation scenario, we would love to see a short confirmation followed by a retracement into the range and then a push lower to new levels. However, as the regular DR session began, there were already signs suggesting the DR downside model might not hold. The regular DR session box closed green, and the overnight DR session mid-level had been violated, both factors reducing the probability of continued downside. Patience was key here. A few minutes into the regular DR session, a 5-minute candle closed above the defining range, providing a long confirmation. This immediately shifted the probabilities in favor of longs, with an approximately 80% likelihood that price would close within the range or extend higher toward new standard deviation levels. The confirmation candle also violated the overnight DR session highs, effectively breaking the DR downside model and almost completely eliminating the chance of further downside. Remember, there's still a chance for a range expansion to the downside, turning into a DR false session. DR models are rather a guidance in combination with other things like the color of the DR box or confirmations, but not a 100% guarantee. Preparation involved highlighting key areas for decision making. Volume and gap imbalances as well as previous DR session levels were marked out. For potential targets, the one standard deviation level was a logical first choice, but the aftermarket defining range highs also stood out as an excellent upside target in this DR model constellation. As price retraced back into the defining range, it rejected the IDR mid twice, offering enough time to plan and execute a trade. A setup here should always cover critical levels, including the previous DR session level, to ensure adequate protection. Unfortunately, the first position would have been stopped out as price dropped deeper into the range, reaching the closing price and the retirement setup area. This deeper retracement presented a second entry opportunity. With only a 20% probability of price closing below the defining range, the trade was worth taking, given the multiple confluences aligned for a successful trade. As the session unfolded, price moved not only to one standard deviation but also reached the aftermarket DR session highs near the end of the session. It was a clean and calculated play, beautifully showcasing the power of preparation, patience, and understanding DR model dynamics. Don't forget to leave a like if you're enjoying these in-depth explanations. Let's move on to the next trade. Number 5. Gold Futures, Tuesday's range contraction model into trumpet price action during high-impact news day. This is a prime example of how a DR range contraction model can develop into trumpet-like price action. While this day was not suitable for trading due to high-impact news like the PPI release, it offers excellent insights into DR/IDR characteristics and price dynamics worth studying. The aftermarket DR session kicked off the DR/IDR intraday cycle within the previous day's regular DR session. This setup defines what I call a DR range contraction model, where price is squeezed within a range. With the overnight DR session completed, the next step is to analyze the sequence of events. By extending the aftermarket defining range levels, it's evident that the overnight DR session breached both the highs and lows of the ADR. This price action invalidates the DR upside and downside models early on, increasing the probability of a DR range expansion or even trumpet-like price action for the rest of the trading day. An ideal trumpet-like price action pattern would show price playing both sides of the market extensively, but a DR range expansion model can also continue in one direction without flipping to the other side. Now, let's shift focus to the regular DR session. What stands out immediately? Look at where the DR/IDR intraday cycle began. The aftermarket DR session was within the previous day's regular DR session, classified as a DR range contraction model. In this case, the previous day's regular DR session lows were already breached at the start of the regular DR session, further supporting the possibility of trumpet-like price action, as the squeeze into one direction has most likely happened here. With a green DR box and a long confirmation in the regular DR session, the bias shifts to the long side. Key target areas include the overnight DR session highs and the previous day's regular DR session highs, supported by standard deviation levels. Highlight critical WIBs and GIBs as well as previous DR session levels that align with the current defining range. These areas provide additional context and potential zones for decision making. As price retraces and rejects the middle of the defining range, a potential long entry becomes visible. It's important to remember that this trade is purely for demonstration purposes, as high-impact news like PPI made this day unsuitable for live trading. With this setup, stops could be placed below the IDR mid and open WIB, targeting the overnight DR session highs and further standard deviation levels. As the regular DR session concludes, price successfully reaches the overnight DR session highs, illustrating a textbook trumpet-like price action example. Even on days when trading isn't advisable, studying examples like this can significantly improve your understanding of DR/IDR characteristics. Number 4, Euro versus the Australian dollar in the Thursday's aftermarket DR session with historical data. If you've been following the top 7 trade series, you should already know what to expect when the aftermarket DR session confirms longs between 8:30 and 9:30 p.m. Euro versus the Australian dollar during aftermarket DR sessions can really be a beast. Historical data suggests a high probability that price will extend at least to the 2 standard deviation level and potentially even higher if the session holds true. In this session, the confirmation occurred immediately after the DR box formation. This gave us an early indication to start preparing for a potential trade. Highlighting previous DR session levels added extra confluence as they often serve as crucial areas for price reaction. There are no previous DR session levels aligning with the current defining range, only one that's slightly above. Since euro versus the Australian dollar tends to move very fast in the ADR, this could be added for continuation confluences. Price presented a shallow retracement back into the defining range, rejecting the closing price and IDR high twice before closing back above the opening price. This was a perfect signal for a potential setup. A clean 4R trade was possible here, targeting the previous day's RDR highs and the +2 standard deviation level. As price continued higher, it offered another opportunity with the previous DR session level now acting as support. Price finally reached the target, almost hitting the +3 standard deviation extension by the end of the session. An excellent example of how understanding historical probabilities and aligning confluences can lead to highly rewarding trades. Join me as I teach thousands of students how to trade like a professional. Learn how to trade the DR trading strategy combined with data, get access to exclusive tools and indicators, weekly live trading sessions where you also get deep market insights, which have never been taught in the retail space before, and a lot more. Visit M7DR.com for more information. Number 3. Gold Futures, Thursday's picture-perfect DR upside expansion model overnight DR session trade. Gold has been trending upwards over the past few days, and the Thursday overnight DR session provided a fantastic opportunity to capitalize on the momentum. The aftermarket DR session confirmed into both directions, making it a DR false session. While this may seem less ideal, it's important to remember that DR true sessions don't happen 100% of the time. A green DR box closed the overnight DR session, signaling strength, and price rejected the aftermarket DR session highs once during this period. All indications were pointing toward a potential DR upside model formation, but the real key lies in waiting for a confirmation. Without that, no trade should be executed. 15 minutes into the overnight DR session, price closed above the defining range high, giving a clear DR long confirmation. This significantly increased the probability of a DR upside model forming, with only about a 20% chance of the session turning into a DR false session. Interestingly, there were no previous DR session levels to the left aligning with the current session. However, one intraday gap imbalance below the opening price and several previous volume imbalances provided potential points of interest for retracement or decision-making. These levels were worth keeping on the chart as the session progressed. Now, with the DR long confirmation in place, the focus shifted entirely toward identifying a high probability long setup. As the DR session progressed, price eventually retraced back into the defining range. It moved past important levels without offering a convincing setup until it entered the retirement setup area. At this stage, multiple rejections occurred. First at the ADR high, then at a volume imbalance, and finally at the IDR low. These alignments of confluences created a textbook scenario for executing a trade. A basic retirement setup here would have easily netted over 3R without even targeting a new high or higher standard deviation levels. As the day progressed, price continued its upward movement during the regular DR session, completing a flawless DR upside expansion model across all 3 DR sessions. Number 2, crude oil futures, Monday's range expansion into trumpet price action regular DR session trade. Let's dive into Monday's regular DR session on crude oil, where we observed an excellent demonstration of range expansion transitioning into trumpet-like price action. As always, it's important to start by analyzing the aftermarket and overnight DR sessions to understand the overall picture and set expectations for the regular DR session. Looking closely at the overnight DR session, the first hour of its range definition was crucial. Price took out both the highs and lows of the aftermarket DR session, which immediately eliminated the possibility of a DR upside or downside model forming. This early behavior strongly hinted at the likelihood of either a DR range expansion model or trumpet-like price action later in the day. With the regular DR session now formed, the defining range closed as a green DR box and a long confirmation followed shortly after. This shifts our focus to long setups throughout the session, prioritizing areas like the standard deviation levels for potential upside extensions and the overnight DR highs, which could come into play in a trumpet-like price action scenario. Preparation at this stage involved mapping out key areas on the chart. The IDR high combined with the closing price and an open magnetic volume imbalance created a high probability zone for a retracement. Additionally, checking previous DR session levels and volume imbalances added another layer of confluence, and these should always remain easily toggled on or off to keep the chart clean and focused. After the confirmation candle, the next two 5-minute candles rejected the DR high and closed above the ODR mid, offering a possible entry. However, with the stop loss placed below the open magnetic volume imbalance, the risk-to-reward ratio was less than 3R, making the setup less attractive. Instead, placing a limit order at a slightly lower entry, anticipating one more retracement before the move higher, was a better approach. This adjustment not only improved the risk to reward, but also aligned perfectly with the overall analysis. With the very next candle, the limit order would have been triggered, followed by a sharp rejection from the previous DR session level and the DR high. This acted as the final catalyst for price to surge well beyond the initial target. Price didn't just stop at the standard deviation level, but extended to 3 standard deviations, fully capitalizing on the trumpet-like price action we anticipated earlier. This session showcased how identifying DR basic characteristics early, such as the overnight DR taking out both sides of the aftermarket DR session, can set the stage for a highly profitable day. By connecting the dots and preparing accordingly, you're able to turn what could seem like chaos into structured, actionable opportunities. And lastly, we're coming to number 1, Bitcoin versus the US dollar, Thursday's overnight DR session trade in a broken DR downside model. Well, take a look at Bitcoin. 3 consecutive red DR boxes, each respecting the previous DR session's highs. This sets the stage for what appears to be a strong DR downside expansion model formation, with all 3 defining ranges gradually increasing in size. Promising, isn't it? Now it's time to wait for a confirmation, ideally to the downside. However, as soon as a long confirmation occurred a few minutes later, we shift our focus to longs, but with caution. Why? Because the DR downside model is technically still intact. Highlighting the previous DR session levels, we can clearly see where the regular DR session found strong support. Additionally, 2 other levels align perfectly with the current defining range, acting as potential zones of interest. As price wicks above the overnight DR highs and violates them with 2 consecutive candles, the DR downside model is broken. This changes the focus towards a potential DR range expansion model instead. With the long confirmation in place, our attention turns to upside targets. The +1 standard deviation level is the immediate objective, but we also have the aftermarket DR session highs as a potential target as well. Throughout the session, price hovers around the DR high and the opening price, even rejecting the overnight DR session mid. This gives a lot of time to plan and execute a trade. For those who missed the initial opportunity, price retraces one more time, offering another entry before finally finding its way above the aftermarket DR session highs just before the session ends. Sometimes the precision of price delivery and the undeniable nature of DR characteristics are simply breathtaking. This trade was a textbook example of patience, planning, and execution. Absolutely perfect. If you've watched until here, you're one step closer to success, and I hope to see you in the next video.
We're gonna take on the world.